So when you've taken out so many significant levels, we refer to them as key levels of significance, you do get this gestation, and people start to think that means it's a bottom because you've stopped going down. No, it doesn't. Generally, things are consolidation towards continuation bias rather than reversal, unless you have.
Hello and welcome back to Real Vision Crypto. Today with me we have Francis Hunt, the market sniper, the crypto sniper, back to share his insights on what's going on with macro markets and crypto markets. Francis, welcome back to Real Vision.
Thank you so much for having me again.
It's always a pleasure having you on. You always share bombshells, great information. And I want to get into first the dollar markets, because the dollar is one of the largest driving factors in all markets. And we recently released this explainer where Damian Horner and Roger Hurst from Real Vision Creative Studios, they released a video, a 1-minute explainer about the dollar and the euro and being at par.
This is a 20-year low in the euro versus the dollar. It's a 20-year low in the yen versus the dollar, and pretty much every other country and every other currency is getting impacted too.
So other currencies are going down and the dollar is just getting more and more valuable.
Yeah. I'm mentioning this because the last few times that you were on, you had mentioned dollar strength as a result of Fed policy. Where do you see the dollar heading? What's going on with the Dixie?
Yes, so we tend to have macro big calls. So sort of 19 going into 20, 21, it was the oil short, the gold long. And coming into this year, so coming in from 21 and around about mid-21 into September, we were saying that the Dixie looks like it's about to start a very substantial move in the dollar's favor, especially against the yen and against the euro, which we charted separately and independently, but are part of that index. And the dollar strength, it also was one of the reasons why we've been tiny bit less popular in the crypto community since the 55K level, on the basis that we're biased to the bear side, and we've tended to find and be more prone to see continuation to the downside, which I'm sure we'll get into later, as a result of this. We also looked at the debt markets, which looked like they'd done a very violent turn. This we were engaged in already in the 20, the scale of the retrace when you look at log scale. So debt and FX markets work very close in hand, because anytime you have a difference in monetary policy, you mentioned the Fed there and central banks, it starts to express itself both in the debt and then in the currency markets. And this has been a dollar driver. So our macro dollar index chart has always been one of expectation of strength. So if I just bring up the charts for everyone to have a little look, you can see how we viewed the world. This one I have done a number of times over the last year and a half that I've been appearing with you. And that's put the case that we are in this channel of upside. In fact, I may just log scale that, because such a big chart. It's a monthly chart of the dollar index. You have a 3 impulse falling wedge that we've highlighted that brought you up to around 213. You had the first major upside break that went with 14.15. That was the collapse of oil simultaneously. You can see how dollar strength and oil, there's that obvious adversarial relationship. And then this has been a continuation. I'll just re-highlight it because there's already quite a few annotations on there. This has been our default view, and it's continued to be that this is an upside continuation. And we still have, in answering your question, which is, Francis, what's going to go down with the dollar? Whilst on the smaller timeframes, we're actually witnessing an element of pullback. Overall, this still has unfinished business for a target that we're expecting on the 111 side, plus the potential for overperformance in that. In the same way, this structure where you see the number 3 had a target up top here, taking you back up to in and around the 100 levels, 97, 100 levels, before resting for a while and now winding up again. So overall, our primary scenario is a bias strength to dollar, which ends up battering the debt and the currencies of all the other nations. So in terms of the Great Reset, we are sympathetic to the Brent Johnson's dollar milkshake theory, that the system fails on dollar strength first battering the other currencies, because that is what, as I'm wearing my tracking shirt today in the sand, that is what the money flow in terms of charts are indicating to us. So this upside break on the dollar index still has further to go, but on the shorter time frames, remember we're on a monthly chart now, we're compressing entire years into small segments. We expect further dollar strength after a short period of rest, which I'm happy to drop down onto the lower time frames and give you. But let me let you unpack that first before I continue.
Yeah, so that was really interesting. You had mentioned the debt and other markets, emerging markets, foreign markets, and this is something that you've also brought up, quite frequently. Is that Forex is the new crypto markets, and I wanted to touch on that as well. What do you see going on with Forex markets? How is the dollar reacting there?
Well, right on the smaller time frames, if we take that macro view, and remember, positioning with a macro is the smartest thing to do. So don't be tempted to short the dollar on the in-between periods. You have three options: do nothing, be long, or be short. Overall, stand back when you're having pullbacks in the Dixie, for example, as we are getting now. So we had this rising wedge. You might have seen you had a pop out the top, which is quite typical, and you can see since then. This is a daily chart just to get the time frames right. The last day, that was 14th July, then the 15th, 16th, 17th are all very much in a retrace pullback category. But the resumption of trend is genuinely your best friend. Continuation is the game, not reversal calling. Plus, as I've already mentioned, those macros have bigger targets. We assume success unless we get real validating reversal patterns on a big time frame. As yet, this is just a pullback. And as you can see, we've already experienced a number, some even bigger scale. We had quite a sustained pullback here during the May month from when we hit the 105. Key levels of significance, 105 high there, bang, next thing you know, you pulled back. Then you properly take the 105, but you can't hold it. Another pullback period. Then we got a little squeeze on the shorter time frame, and we were aggressively leverage long trading that. Remember also that some of the two big constituents outside of the pound and the Swiss franc is the euro itself and the JPY. And both of these, in terms of economic policy, the Eurozone just recently came out with their stabilization mechanism, clever transmission, funny phrase, which sounded awfully like a yield curve control that the Japanese have. So you're talking about the narrative slowly comes to you that actually they want to hold up or need to sustain their debt markets, and they may have to do certain activities to help proliferate fiat to sustain debt, because essentially money is borrowed into existence, and the failure of the debt markets would be the failure of the entire system as a whole. So they're going to keep needing to be more dovish. They might talk tough, but actually I think the Fed is going to be the stronger, and I'm expecting a super spike. You've seen it on the Korean won, our expectations there, and that is behind the yen that is right here. But why are we going to rest now? Well, I want to highlight this because this is seminal. A couple of times we came on to Real Vision and said this yen has got 136 target to do. And this comes out of a really macro structure where we're in a holding pattern for an extended period, squeezing and squeezing. So these targets gave 136 for us. And that's why we said, look, you're probably going to have a little rest. And that's kind of what we're going into now. Whilst at that 136 target, once again, we're on the back of the monthlies, the high time frame. If I take you back onto the lower time frames, you can see we had a smaller final little squeeze. So often when you're at that main target level of 166, which was over here, you then got another little squeeze and you get a little bit more at the bottom of the tin. And that took us up to the 138 target. So we closed this trade. This was on live trading day. In fact, the payrolls of last month triggered that, and then you were home. And since then, a little bit of a pullback. But going back up to the 8 hour, it's a rising wedge. We're squeezing up higher. I want to warn people, however, rising wedges don't only break down. You could rest. We have three alternatives. So it's very much a decision time for dollar moment. We have what we call the three impulse rising wedge that I'm referring to. And I'll just highlight it nice and clearly for everyone to see because there's a lot of annotations on here. Big first impulse. Here's your secondary one where you squared up a little bit and you did that final squeeze up. That's now giving you a third impulse inside of this wedge. Now, the big question, the $1 million question, the $10 million or maybe the $1 trillion question is what comes out of this. Traditional technical analysis tends to err for a sell-off and maybe a longer pause. So maybe through the summer, we back off the narrative on outlier dollar dominance, and that reemerges later. Longer run, however, we're going to be dollar bulls, and I'm going to avoid going into the short side on the dollar. So quite a long answer, but I hope that helps give you some guidance across a number of time frames and also across the USD JPY. And one final point before I finish, however, is it's absolutely typical after a parity run, we expected a rally. So that is going to be a headline grabber. In fact, we had a smaller structure here that literally gave us the parity run that we also did share on Twitter. Very flat bottom, idealized inverted HVF structure. And you get your parity run there. And then what's happened? You get a rally. But overall, stay with the boss.
Yeah, understood. So going back to the previous chart, you had mentioned that rising wedges don't always fall down. Sometimes they can break up to the upside. What kind of targets are you seeing there if that does happen?
So it's very hard to target off a rising wedge. So we were on the yen when we were talking about the rising wedge, although I would say that's the big one with the red line, the solid red line, and the solid gray. Very hard to target off that. You'll notice the structures where you square up are the ones where we've generated targets. And of course, the macro one on the monthly, which gave us this 136 target, the initial. So this squaring up gave us, okay, you can have a little bit more, take it again for the 138. When you're in a rising wedge, it's far harder because instead of having a horizontal point that we kick our amplitudes up for our targets, you actually have what we refer to as a splitter, an angled line that has different values at different altitudes. So we use over performance management, which is a totally different technique for staying on our macro longs in the yen for when we would eventually exit. And it's almost too detailed to go into here. And it's not something that throws out a specific target. We put a trumpet, a broadening structure, and when that is broken, that is a point when we may exit. And that could be anywhere.
Okay. Well, so with that as a backdrop, what do you see going on with crypto and more specifically Bitcoin? So we've seen a kind of recovery. We don't know if it's a recovery bounce, but Bitcoin, I think it's up around 20 to 30%. Ethereum, Solana up much more. What do you make of that recovery bounce?
Yes. So the big problem, you're quite right. And I think you mentioned, Raul, it also highlighted this Bitcoin dominance element that actually the Bitcoin dominance has been bleeding out. And generally, that's not a good thing. I'd prefer to see Bitcoin overperforming to the upside in an environment that would bring and the alts along with it later, than see what we're seeing now. Bitcoin being relatively heavy, and we'll just pivot quickly from the Bitcoin chart that many people will recognize to the dominance chart. You can see that we're actually bleeding out. Ethereum did really nicely. I think these are counter a larger bear trend rallies for the alts. And because Bitcoin is not officially going down and is walking out to the upside a little bit, still, and I make this very important point, still within the structure of three bears. So people have been waiting for us to turn bullish and they've been disappointed. And we've spoken of the three bear flags. I call it, it's almost like Alice getting, who was it? Goldilocks getting lost in the woods, the three bear flags. And unfortunately, they've all broken and resolved to the downside. The observations people will make, if we have a look at the bigger time frame is on these bear flags, is that they've all resolved to the downside in this environment. However, we have just said what we've said about the dollar. We may have a longer pause before it resumes, but our emphasis or our expectation is that it will resume on strength. And I'll show you those flags over there. You kind of had a first warning one. And the interesting part about this is this was your 50K. So there's a concept called pegging that's very much associated with derivatives options. And these tend to occur at round numbers. That is a 50K level. If I draw the horizontal line through that, that's at the 50K level. This was at the 40K level, a flag again, a much bigger flag. And for quite a while, people were thinking, well, that's it. We're over with the downside. That was your 40K level. You can see this value running almost diagonally through the flag, and very similarly for the 50K over here. Unfortunately, all of those broke to the downside, again with reassertion of dollar. This is a smaller flag, and it was based on the 30K level. So this is, again, unfortunately, you're shedding 10,000 in each of these falls, flagging and going again. Subsequently, you're down here at the 20K level. You can see the pattern emerging here. It's not broadly a particularly positive one. Now, eventually, one of these fail and will be incorrect. But our basis and our thesis is on balance of probabilities. We keep on keeping on the basis that continuation dominates reversal. And this structure here does not constitute reversal structure on Bitcoin. Bitcoin we refer to as the God market of crypto. The others can go play and get all bouncy and happy like puppies. But if the rain comes back and Bitcoin turns down, they will be dragged down. So I don't know if that's fully answers your question.
Yeah, no, so that's really interesting. It's looking at that pattern, looks like a downward staircase or heading down. And where do you see that target going? And also, I noticed that you tweeted earlier this week also that I think it was on Monday that we hit the top of that channel and we were rejected. So what do you see with the price there with that specifically with Bitcoin?
So looking just more specifically to the flag itself, so we'll get off the daily and take it down to answer your question. This range is a very important range, and there's a reason why we stalled for quite a while. In fact, it might have been this risk-reward ratio possible trade that you saw on the Twitter as well. We made 4 major levels here. And that's why you gestate at that level. Just like I was making the point about the Euro USD doing the headline grabbing parity run, it was almost a no-brainer that it rallied. The Euro Swiss franc had done exactly the same before when the Euro Swiss franc ran the parity level. So we're seeing key levels. Then they rally, they take you off the scent. They get you to forget about the Euro short trade when you should be dominating, keeping the pressure on the Euro. In fact, you'll get better entries. It's an opportunity to short higher up. In a similar way, we made the 20K key round number. We made the legacy high at 19.89s, very close. That's that gray level there. That was essentially a support. Many people will see previous resistance as serving as some degree of support. Then you also made a bear flag downside that we'd drawn, the last one. This is the geometry that came down. That was captured just on a wick on this time frame. And you also, this is very much an HVF level, most people would not understand unless they've done a program, made a second interim on the 2.5-year setup that broke from the 8, 9, 10K to run all the way to the 64. That was a legacy key level for us on the way that we're now meeting, unfortunately, on the way back down. So when you've taken out so many significant levels, we refer to them as key levels of significance, you do get this gestation. And people start to think that means it's a bottom because you've stopped going down. No, it doesn't. Generally, things are consolidation towards continuation bias rather than reversal, unless you have inverted head and shoulders and very clearly identifiable. This pattern and price behavior, when it came and just kissed the top end of the channel, which is what you were referring to, is actually potentially quite a low risk entry for those that are bold enough to take shorts and understand money management. This is not a trade recommendation. This is not financial advice, usual aspects about that. But in actual fact, the 23K, you've got some relative highs around here. You could put a stop around the 23. You could hedge a hodl portfolio with a Bitcoin short, for example, for the 10K run, all the way up here at around 22K with a very short, about under at the 20, we're at 22,200 at the moment for literally $800 move. You could put on a better part of a 12,000 target, which when you're talking risk rewards, remember our game, if you're trading or investing, is how much juice are you going to get for the risk of that squeeze? If I just scale this so that you could see where the 10K would start to come in, it's quite a substantial downside. Many will look and say, that's never happening. Well, I'm afraid to say we've drawn 3 of these already before, and those 3 have already happened, and you're on number 4. So that's a 14.5 risk reward potential trade to. And maybe if you're holding certain tokens, if you have the skills, you can almost hedge your downside exposure to that, particularly if you're hodling Bitcoin in a cold wallet, for example.
Absolutely. Well, a 12K Bitcoin is definitely something that sounds like a scary news to me. But let's assume that Bitcoin doesn't go down and the trade's kind of maybe more sideways or even some upward momentum. Where do you see the technicals of altcoins, Ethereum, Solana, and the other altcoins that are prominent in the top 10?
So also Ethereum, such a significant token, Raul is very positively disposed to it, and I think he's right. There's a hive mind of great value in there. But the point I want to make when you're thinking about it is you should look at ETH-BTC and ETH dominance. And ETH dominance is essentially how big is Ethereum's market cap to all the players. And I'm going to show you a little bit of work we've done on, say, ETH, because I think it's the most significant other token. And I want to warn about getting too aggressive about longs. So the 20% dominance for ETH has been quite thin territory. And in actual fact, Ethereum lost a lot of ground. In fact, all the alts did when Bitcoin was staircasing down. What we forget as Bitcoin dominance is relatively weak now is how much more alts fell in those down legs than Bitcoin did. Bitcoin was dropping 10K a time. And when you're at 50K and you drop to 40, okay, it's 20%. When you do it again, it's 25. When you do it again, it's 33. But in some instances, some of those alts were shedding 60% in each of those down legs. So what you've had is, for example, Ethereum's dominance fell right down to 14%. It couldn't hold that magic 20%. Actually, all we've done so far is get back into the heavy traffic zone, which is very much a consolidation and a difficult hold for Ethereum. So I wouldn't be the charge-in buyer at these levels. Lower down, when you saw this possible reversal occurring around here, you could have speculated on that, but I just don't feel the long side is the safest side to be playing when you could have at any point dollar dominance reassert. So alts, getting sucked in on the alts are people that generally are trading low time frames, and that's a concern for me. And you should have the macro wins in your sales. So for me, the only way is nothing or short. Until such time as we've had a proper reversal and we failed a continuation to the downside. As long as you keep getting positive enforcement for your trend bias, then you should stay with it until. That means you will be wrong once at the end, and I could well be at that point.
I want to now pivot to equity markets. You've previously mentioned the correlation between Bitcoin and tech stocks. What do you see going on there?
Yes, it's a great question, because unfortunately, when you have institutions involved, they bring their valuation models, and they'll just see it as possibly some hive tech mind and undervalue. How does Bitcoin go up in an environment where actually it's probably the most bullish scenario I could draw right now would be for me to say right now this could be, assuming we don't start spilling harder. I mean, were Bitcoin to go from that 20K to the 10K, which is a possibility, not a guarantee, obviously, you would probably be once again overperforming to the downside, the tech market. For the tech market to just to lose similar level, it would need to lose 50%. And on top of what it's already lost, that's quite an ask. So that would put, once again, Bitcoin on the higher beta. But there is a chance potentially you're in some form of falling wedge. This is one to be watched for when we finally get a pivot of relative strength out of crypto. For example, you could have that same three impulse type falling wedge where you get the very bloated descended second impulse, often is the case. You get that third, and then we have that event that everybody will be waiting for, but not too soon, where you might start to get overperformance. However, as I say, if we spill the 10 to 20K, you get disorderly and you're coming down out the bottom of this. That means we will have run this descending grind line of support. So there's been tactical retreat where some buying, relative valuation buying, aka tech versus Bitcoin, has come in, but each time it has forged a lower low before it's made its presence felt, and we are still quite close to that bottom. So I don't think there's anything too strong yet for you to hang your hat on to say that Bitcoin is going to start overperforming the NASDAQ. Regarding that, I want to make a comment on the NASDAQ, just generally outside of the Bitcoin, because obviously it's important. We still have a head and shoulder on the NASDAQ that we have an open target for. The S&P and the Dow have made those targets, although we expect a bit of overperformance again through there. We think we're at a close to cyclical high. So we are quite bare in generally in terms of these things. We're very bullish the dollar when it reasserts. It's resting now, and we're quite bearish. We think this comes into quite a high stress period. Don't forget, if you listen to some of the news, we're talking about Europe possibly having energy-based lockdowns on the lack of gas, preparing their population. It's quite unheard of, and we suffer from hyper-normalization. We're starting to think, well, yeah, so what? This is it. It's indicative of quite a tricky place. The fact that we're even considering the fact that first world nations like Germany, etc., will have electric grid down. So here's that NASDAQ head and shoulders. That is triggered. It's still got a 9.2 target to run. So whenever we trigger, our process and methodology is we assume success until such time as a stop is run. So your stop should be right up at the right shoulder on this NASDAQ. That is a triggering event, and you're in a period of progress decay, so a bit of chop and churn. Of course, we've got the dollar resting now. It will give a little bit of risk on back, and it will then subsequently return with some vigor to the downside on some new narrative, or maybe a very high inflation number, or a variety of things.
And where are those targets for you mentioned the right shoulder, and then what targets are those?
So the target on the NASDAQ, just to make the head and shoulder, and remember, head and shoulders are a beginning of something. They aren't necessarily over because they run a target, but there's likely to be some respite and maybe a rally. So rallies are things that occur in bear trends. Corrections are things that occur in bull trends. This would be a rally because we would say this is a reversal structure from a bull market that came out of the COVID stimulus that saw such a surge. People forget how much you surged from the March 20 lows. Just to get that in context there you are, just prior to April. It's an unbelievable move, 6,600 to 16,000 to the peak of your head. Retracing to 9,000, especially as stimulus is not really the kind of thing that's on the table right now. And we're removing liquidity. This could have round tripper potential to quite some way down. So the target is 9.2 there, just to show you that some of those things have already performed on the SPY, which is your S&P 500. We are gestating at a target level. So everything is at targets and therefore counter trending at the moment. We see it in our USD JPY. It makes perfect sense to us. We see it in the euro with a parity run. It's rallying. It makes perfect sense to us. The S&P is at its target on the head and shoulder and is not going further down. It makes perfect sense to us, but we stay the course of the macro. So those are the reasons. The same with the Dow. The Dow also made its head and shoulder. You can see it's run it. It's still in a broadening structure for down. It makes sense for us that it's rallying. You made that target around about 13th of June. And since then, this has been a bunch of gestation and a little bit of fear, and then coming back to, okay, we're getting used to the fact that interest rates might go up 100 basis points or 75. But I think there'll be another wave of fear to come.
You mentioned interest rates 100 basis points. I've heard some people talking about that as well. Where do you think, what levels do you think that things need to get to for the Fed to do that, but then for them to kind of step back into the markets, add more liquidity and those kind of things for the markets?
I think they're going to push far deeper into the point of pain than they have done as before. Everybody's expectation is a Fed pivot and then proliferation again, and liquidity policies. Therefore, my expectation is we go far deeper and things have to get far more critical before that event occurs. And this allows room for the dollar dominance. You've also got to remember, everybody thinks it's purely about inflation. Never has the dollar been more challenged, and the natural tendency is to use dollar strength when it's facing a challenge. When the euro was launched, it fell all the way from about 1.6 to about 0.8. Because the dollar saw, okay, we need to show you who's boss. Now, with what's gone on with the deglobalization, Russia, Ukraine, without doing the whole geopolitical dive, there's more challenges than ever before. And the dollar's natural response is actually to assert dollar hegemony and power and strength, and to create desirability where you're earning a higher rate of interest in your dollar-held deposits and the currency is appreciating. No one wants to hold yen to earn 0.2% and to devalue as a currency globally. So if you're a global treasury of a multinational, you would bias to holding dollars, even if you're not an American multinational. If you're a European business, if you're Mercedes-Benz and a treasury department, why are you going to hold euros over dollars? In terms of money, unless you need euros at that particular point and you don't yet have them. So this dynamic, and the irony is the people who are getting most beaten by this are not the Russian ruble and the Chinese yuan, but the allies of America in the form of the Eurozone and the yen. So the dollar protecting itself is beating its allies, and this is a fascinating narrative.
Something else that I've seen you cover before is bonds, treasury bonds. What do you see going on with that? I mean, the 10 and 2 yield curve is still heavily inverted. Where do you see those markets?
You're absolutely spot on the money for asking the question, because I wanted to cover that in the other answer, but I have to restrict myself from going too long form. You're absolutely spot on by asking, what about debt? Because this is the other magic point. In part of defending the dollar, America also needs to secure a bid under its debt market. And by giving a dollar strength, they can support their treasuries more so. What you will have seen, and I'll refer back to this chart, which is also one, I'll just flash it up because it's been shown many a time here over the last 2 years that I've been appearing with you. But when we log scaled this final capitulation was real end of trend material. So you get a capitulation. You see that? That was the yields, by the way. So we're looking at the 10-year yield. Most people are familiar with that. During this period, bonds are going up in the inverse manner to the yield going down. So this was peak valuation bonds down here at 0.3, which is roughly where the Japanese still are. In that period, this is what's happened on yields. And if I just switch my jaws back on, I'll highlight that the 3% range is such a critical range. And we predicted that you would overperform and get to 3, and that you would gestate and rest here. So further to pointing out that all the stock markets are conveniently at all their targets and gestating. The euro did the parity and now counter trend running. You are getting the exact same on the yield. All the narratives of all the core markets are now in what I describe a progress decay mode. While the general trend is ascending yield, but you've hit key levels of significance and now you're being made to pause here. So 3%, a very, very key number, in the same way as parity for Euro USD, the two biggest players, in the same way as those targets on those head and shoulders. So we are in that frustrating summer doldrums to some degree, where some of the core dominant trend is actually being pushed back against, and we're in a gestation period. But we come out of it in continuation rather than reversal. So to answer the question, where do you see yields? The short form answer is higher and more pressure on debt. But what the America will do will redrive dollar dominance to make sure that it keeps a bit of a bid under its debt, which will be to the detriment of the likes of, say, the Italian debt with the euro malaise and other debt markets. So now people who have to be exposed to debt markets now have to ask which debt, and it's a beauty contest of the lepers. And I'm afraid to say the dollar will put on more lipstick and a little more makeup and will attract more of the funds, and the euro lepers are going to be caught out. And unwanted and unloved, and this is going to lead to further contagion, which will express in that dollar spike that may well bring the likes of the USD Korean won home to that huge move that we made prediction a while ago.
Fascinating conversation, Francis. Let's wrap this up here. Final takeaways that you have for our viewers and our audience with regards to Bitcoin and Ethereum and dollar dominance.
So I think this is the most important for the crypto guys. Unfortunately, things are out of your hands to a degree by bigger gods than crypto gods. This is the macro environment. Thor is slamming his hammer, and it's the dollar dominance theme. Yes, you're getting a respite at this moment, but you trade against the trend at your peril. So all short-term rallies resist the semblance to call bottom and to FOMO in spite of Ethereum doing rather well and having quite a substantial rally. It traded sub 1,000, was in the 900s. Now you've got back up. You possibly whiffed 1,600. It's quite tempting to engage. This would be counter trend trading, and overall, in terms of both macro investing or being slightly more active and position trading, I think trading against the dominant trend until you've had clarity on reversal is not good. So for my crypto friends, my suspicion is, despite it not sounding feasible and despite you having a little bit of counter trend movement, it's quite possible Bitcoin trades lower and will drag the alt market again down with it. So you get, the worst thing is the hope, and then a final beating on top of that hope is really morale crushing. Also, in terms of some of the events you mentioned, Marco, regarding Luna and Celsius, I am very technical, macro technical driven. This is why I'm not prepared to buy bottoms on this level of price behavior. But who knows what other fundamental narratives could come? You could have crypto specific ones that still come out of the woodwork that you thought were safe. Or you could have larger macro drivers that just dominate the crypto market, even wanting to be positive, that they get crushed. If people are forced sellers, the price doesn't matter. If they're getting beaten elsewhere and they are forced sellers, the price doesn't matter. Liquidity gets pursued and cash is sought. And there's a lot of leverage around in all systems. And as a result, don't trade the rallies long until we've had clarity on reversal. Bitcoin is the god market. It is not doing enough to justify a new bull trend yet. The volatility is reduced, but it's still in a pattern structure which could suggest further downside, such as a bear flag.
Amazing analysis as always, Francis. Before I let you go, where can viewers keep up with you? Your commentary on Twitter or wherever, where can they keep up with you?
Thank you for that. Yes, so we're on the YouTube channel, The Market Sniper, for traditional markets, and we do The Crypto Sniper for the YouTube channel on crypto markets, and the handle is the exact same for Twitter as well, at The Market Sniper and at The Crypto Sniper. And if you want to go straight to engage with us, the website is themarketsniper.com.
Awesome. Well, we'll have to have you back on soon. Thanks again, Francis. Appreciate you coming on.
Absolute pleasure. Thanks for having me.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.